Hi everyone, welcome to the Twitter Ask Me Anything questions and my answers to all your questions that you've asked over here. I'm going to scroll down right to the bottom and start from there. And this looks like a question. What does Nifty know that we don't? There's no question here really. Well, it does know something. It knows that the bulls are currently having an upper hand in the structure of what the market is really doing. It's proving that time and again and requires us to really delve into what the real reasons are. We've done a lot of that in the weekend with Indiacharts. Now, view on metal stocks and commodities long term. Now, remember that the metal index, especially if you look at the BSE metal index, so I'm going to open that, has broken out of a very long-term congestion zone. Okay, and this is multi-year, which is why I'm using the BSE, because it has more historical data all the way to 2004. So what you end up noticing is that the last bull market, in the metal index ended here in 2007-8, and after that we were in a long consolidation phase. So we call this entire phase a complex pattern or a triangular pattern in which prices just consolidated. If I consider it triangular, I may even say it's a fourth wave longer term. But what's more important is that we have broken out of this phase almost, getting close to surpassing the previous high we did for a while, and we are holding over there. At least from a pattern perspective, we have broken out of this pattern. In fact, this level has worked as a support from where we broke out if we put a trend line of all the highs together. And I would really mark this high therefore as wave 1 and 2 of a new bullish phase that has started in the metal index. So we have a very long way to go as far as the long term is concerned. This is just like the first wave, the first rally in what is going to be a multi-year bull run for the metals markets. The only waiting phase in such phases is that, I'm saying if this is 2, what if 2 goes on for longer? What if we keep consolidating and then the third shows up? That is the only thing that can go wrong. We'll continue to try and anticipate when the next wave starts. But whenever it does, and I think it will start sooner than most people think, then we're actually looking at a lot more. Third, then there's a fourth, then there's a fifth. I don't know how many years we can guess. We can make a guess on that, but it's definitely a long period of time. And therefore, this is a sector that I'd want to continue to remain exposed to if I have a multi-year view. Shorter term, it can have its own gyrations. And that's what is visible in I think the same setup is visible in individual stocks. Some of them have retraced more than others, where they've actually pulled back 61%. We see only a 50% retracement in the metal index, the BSE metal index. If I take the Nifty NSE metal index, it's retraced much more, but then NSE metal index has all the Adani group. So therefore, that can be a misleading factor in terms of the structure of the metals themselves. But the BSE metal index shows a 50% retracement. Some stocks like Hindalco have done 61% retracements. Each one is different on its own, but in general, this is what the sector is really indicating. So that's answering the first question that we have here. And with that, I move on to the next one here from Mitesh. Where do you see the bottom of this pullback, and post the short-term correction, where are we headed? Bottom of this pullback. So he possibly thinking that, okay, the current move that happened last week, now that is already done, but let us just look at the way forward. I think I did another Nifty video today which gave some insights on that. Let me take a blank chart, and I'm also going to take an intraday chart because this appears more like a short-term view on the immediate setup. So in a sense, we were looking for support coming in, close to the 20-day average, which happened, I think, at both of these lows. What we've also been trying to guess throughout this time phase is whether this is 1, 2, 3, 4, is it? And after 4, are we done with 5? Because the initial wave was a 5 wave up and then it pulled back. Okay, now this is of course not the hourly chart itself. So let me just now A note, you may not see proper date and time settings on this chart because I've actually tried to use a slightly different chart, I do that just because the old Metastock data from Viratech used to come in on a different time period, and that's something that I got used to. So when we look at this, what we were looking at is that, okay, you got a correction here. I'm thinking this is an expanded flat, which means it's a A, B, C, where C is 5 waves down. Okay, so some people are right that this was starting to look like 5 waves, but it was wave C of an expanded flat, which is now proven because this high has been surpassed, right? And so after that, we were thinking, okay, if this is the fourth wave, is this phi or is this 1 of phi? And you don't know that initially. You can see a very clear 1, 2, 3, 4, 5 wave structure. You become more sure of that when you are sure that this is only a 3 wave decline. So that was, I think, critical. Not only that, it touched exactly 61.8% over here. Okay, and when you actually do 61.8%, then you've retraced a critical level, which is usually in wave 2. You'd want to see that kind of a 61% retracement. So it holds 61%, and in ABC, that's the second thing. So when both of these things happen, that then gives us confidence at this point of time. So if you asked me this question a week ago, I would have simply said somewhere down here, 20 DMA, 18,000, 18,100. There were multiple levels I had between 18. I think 1880 is where the 20 DMA was here. It didn't touch it. It fell below it slightly, came back up, retested it again a second time, and then it's gone on to make a higher high. And in the process, we are trying to figure out whether this is the fifth wave or just the first and second. So right now, our thought is it's the first and second of the fifth, and we are right now going on in the third of the fifth. That's now proven, and we were able to take that cue once it bounced back from here in 3 waves, and now it's going on. So the real question should be, where does it go from here? Now, it could be equal or it could be 1.618 times. Being a third wave, it can have an extension. So if we actually do an extension to this, then we can simply apply a Fibonacci extension, and 161% ratio would spread to 18,789. Okay, so say 790. So 18,790 is where we'll end up in 3 of 5, right? So 3 of 5 is going to come up till here is what we'll anticipate. There can be a slight variation. There can be more extension, but this is what helps us get a starting level as to where we are going. And then we'll, of course, if it does stop there, we look for a fourth pullback and then a fifth higher. And how that unfolds will also tell us in terms of big picture, should we really change this count from 1, 2, 3, 4 or not. Now, I'll not go into details of that. That's something we've discussed a lot in the weekend with Indiacharts. Now, why is this negative correlation between VIX and Nifty disturbed in recent times? Even today, both Nifty and VIX are down. Interesting question. What I'm going to do is I'm going to open the combined chart on TradingView, my intermarket charts. So what you're really talking about is what we see on this chart. That is, historically, yes, if the VIX is rising, markets are falling, and markets are going up, then the VIX starts to come down. Which is completely true. But what you may not note, and this chart might not have historical data all the way back to 2000. I have some of that data because I used to keep it on a separate Excel as to VIX. Otherwise, the NSE data is only, I think, from 2008. In a bull market, sometimes the VIX can actually move up to a higher level and stay there because it's rising very, very fast, and therefore you can't have IV very low, right? Because IV is not just directional, but it's also got to do with the standard deviation of the market. So it has to do price in both. One is, of course, the fear. So if fear is less, people are willing to pay less and less for those options, and therefore the premium comes down. But it also has to reflect volatility. So if volatility reduces, the VIX falls. But if volatility increases and prices are rising very, very fast in a bull market, the VIX can actually go up. It can get elevated. For those who don't know, if you've never looked at a US VIX chart between 1995 and 1998, when the tech bubble was going on, the US VIX actually went up to a higher level and stayed there for a long period of time. So something like that also happened in 2002-3 once we broke out into a bull market. This is just important to highlight. That doesn't mean you don't get inversions in relationship, but these inversions are very, very medium term. So what you're talking about is this very, very short term gyration where, okay, here the market's going up, but the VIX is still not looking like it's going down because it's stuck in this range. But it's not supposed to happen on a day-to-day basis. This is something which will happen like by the time the market reaches up here, this VIX has to go down and eventually reach that 8% goal. And reason I say 8% goal is because that's where we've had many of the historical bottoms in the India VIX. If I just scroll back out, and we draw a couple of horizontal lines on this chart, you see these bottoms over here. Okay, the bottom end reading is close to around 10 or even lower in some cases. If I take a bar chart, you'll see the extreme low going really down, so it's down here. Okay, so that was a line closing chart, and right now we are still at, so that's close to 9% and we are still at 11. So the India VIX is progressing downwards. In fact, I think from this point on, if I simply draw a line, it's like this. It's in a downward channel and it is progressing down, except that it's not doing so every day, because now say if this market moves up very fast, can the VIX just go down? Because it's representing a higher volatility range. So what will end up happening is the VIX will just stay here till this slows down, somewhere and loses momentum, and then you'll see the VIX really drop. So that's just how it works. Look at this phase over here. Okay, the VIX actually moves up during this strong part of the rally in September of 2021, and it actually topped in October, end of October. And by that time, see, there was a spike down in the VIX, but actually at this top, you find that the VIX is at a higher bottom than it was at this point. Which brings us to another point that, we are all so short-term oriented, 1 day, 2 day, 5 day. You miss out that medium term, you get divergences as well, in the indicator, which means you see the max fear point is over here, which is here when the Russian invasions were happening into Ukraine. The market did make a lower low over here to 15,200 in June. But did the VIX make a higher high? The answer is it did not. Now you would say, what the heck? But that's what we call a bullish positive divergence. A new low in the market, but not a higher reading in the fear index, which means people are less fearful at a lower point in the market. And that is a bullish positive divergence. The same thing happened here at the top. So it would also happen at some point here that, you'll get a positive divergence in the VIX. I'm not thinking that is the case right now. This current divergence, I think, is more got to do with simply the speed of the market. But you can't really analyze VIX on a day-to-day basis that, if it's going up for 10 days, then, if the Nifty is going up for 10 days, the VIX is supposed to fall for 10 days. It doesn't always work like that. Surely it may have looked like that here, but just because it did look like that here doesn't mean that it's always going to be the case. Okay, so that's a long conversation on the VIX. Currently, I've seen people shorting stocks making money even when Nifty rallied so much. थोड़ा सा ऊपर घूम सकता है, नीचे आ जाएगा. Buying stocks and making money has become tough. Will it reverse? I think it has already reversed. It was true in March. It was true to some extent in early April because some stocks were still making new lows. But what I'm noticing one by one is even the stocks that were making new lows or were falling for one and a half year consistently are turning around. I could randomly, let's not say randomly, I could pick up some stocks here which I've saved, say Borosil Renewables. Okay, this was a hot stock for a while, but it is completely dull over here. I know this is not your typical trading stock, but I'm just giving an idea. It was dull all the way till here, not participating, and now all of a sudden you're seeing a move. Okay, and when you start seeing that, so what does it really mean? It means that weakness that we were seeing in individual stocks is going away, and it's happening all over the place. So what you're referring to is probably day traders. Maybe they get a hit at something because there's another fact. It's called rotation, right? And rotation is that when the market keeps going up on the back of some sectors, at some point of time, those sectors start exhausting and then you see a correction. We've seen that in, say, PSU banks. So if you actually open the PSU bank index, you'll find that the Nifty PSU banks or the pharma stocks, for example, have completely pulled back to the lower band. But you do not see the same in, say, the auto index, right? So it's possible some people ended up having that experience that they shorted something and it actually went down. But can I really extrapolate that? And it may have actually worked. I'm not denying it would have worked in the short term because breadth actually does cool off at some point of time in a rally. Everything doesn't continue to go up in the mid stage of market rally. So I'm going to show this to you with the Indiacharts strike software. Okay, there is some delay. We are working on a lot of new tools and new additions, perfecting things. So we have pushed the deadline to make it public sometime by the 17th of June. So you're going to have to wait a little longer. But here's a look at the 20-day average of the advanced decline ratio. Now, what do you really see? You see a market that is going up, okay, making a higher high here, even as the breadth actually peaked at this point of time, which is somewhere here, and this 20-day AD ratio has been coming off. Now, just because it is coming off, does it mean that the market will fall? We've got a small correction, but again, it's going higher. So this is a tendency of markets, okay, especially when you have a strong bullish trend. Now, if it was a bear market or it was a trading market, like the one we had last year, yes, a high reading like this could have meant that you're at a market top. Or you could have had a couple of divergences before you got a market high. But in a bullish market, let's just scroll to the left hand side. Let us take this phase. What happens over here? What happens when the market is trending very, very strongly? You can get a high reading, causes a small pullback. After that, market is still going up for more than a month. All the way from this is July and here this is September, July, August, September. The AD ratio pulls all the way back down and then picks up all the way again. So what did it really mean over here? What this really means is, in a single word, rotation. Okay. So rotation is something that we just have to get used to because it's part and parcel of how our market behaves. And sometimes some sectors do well, sometimes other sector does well. And that shifting keeps the index moving. But if you are in certain stocks, you could end up shorting them, making money. It doesn't have any meaning for the market itself. So how the breadth indicator is really behaving, interacting with price also tells you something about the market. If negative divergences are not resulting in a correction, it could mean that this trend in the market is actually very strong. It's not that every time there's a divergence supposed to crash. Okay, so it depends on what type of market you're in. If you're in a bull market, breadth behaves in a very, very different way than when you're in a bear market or a trading market. So the next question, yes, especially Infosys on its third and fourth guidance and the stock tanks 20% IPCA labs. How could a company do like that and why? Now, this is a complicated question. On its third and fourth quarter guidance and the stock tanks 20% IPCA labs. I'm not sure what the question really is. Where can a company's guidance change how it behaves? I mean, the markets are always trying to price in forward earnings, and if the earnings guidance changes, definitely a stock reacts. So I'm not sure what answer to give to this question. I hope it was framed a little more appropriately in trying to get the right output from me. Your view on auto index from the medium term Elliott wave perspective. Very strong. The auto index has proven itself by actually holding out against the market even when it was falling to 15,200 last year. So here's the BSE auto index. When that entire fall occurred, which was somewhere I think between April of 2022. So that is, let's look at where that is. May, April, yeah, somewhere here. Okay. So April, so somewhere here April and all the way till June where we hit 15,200. The auto index actually went up till here and then it stretched a while longer. And then when the market continued higher to 18,900, the auto index was just consolidating all the way till March of this year. And now it is taken out of this. Okay, you can actually see my broad counts. I've tried to complete a first and second wave here. We've probably started a third and had a long consolidation. I have two options here. One is I've tried to complete 5 here. The second one is I take this as 1, 2 and this whole expanding pattern as a fourth and then a fifth starting. In either case, we have a lot more to happen. And as this develops, I take it stage by stage. One is counting one particular impulse. So if I go really short term, this is 1, 2, 3, 4 and we are in the fifth, which is doing a 1, 2, 3, 4, 5. When that 5 completes, we will see a consolidation. The question becomes then, is this consolidation 1 of something new, 2 of something new? And inside this larger count, what is it? Now, of course, if this is a larger first and second, then this will only be 1 of 3, 2 of 3. And then later you'll get a third of third higher. But yes, there could be some consolidation once we complete this 5-wave structure, which is also not over as of now. And I would think if I had to put a number on it, I mean, I think 1 and 3 of this are almost equal. So I would expect fifth also to do something similar. In that sense, the auto index goes on till 34,440 BSE auto index. So still got room to move higher because the structure is not yet complete. You see IT outperform the banking index. I've never been much of a relative trader as to one outperforming the other. But I think within IT, there'll be strength in mid-cap IT and probably less strength in the large-cap IT. I think that's been the theme. Although large-cap IT did very well post-COVID. But I think somewhere that that may change. They may start behaving the way they were doing pre-COVID. Where the mid-cap IT was doing far better than the large-cap IT. I think that pattern may return is a sense I'm getting. Not so sure. So which means you have to segregate that basket into the big stocks and the small stocks if you're really looking at gains from IT. But otherwise you can't have banking not perform in IT if the world is doing well. In general, IT is a back end of everything today. So you can't have the IT sector also not do well. But surely the smaller ones, smaller companies with particular products tend to have much more higher growth rates and better performance than if you're very large and if you're only in the labor arbitrage business. So that's broadly how you think about it. But in general, if we are bullish, then we expect every sector to do well. Getting down to the last relative strength, 10% return versus 12%, that is not my game. How do we see seeing the top in Nifty now? That then how far Nifty can come down from there within 1 to 2 months time frame, which future stocks are looking good for 1 to 2 months. Now, of course, we will not make recommendations on particular stocks because we are not advisors. I put out wave counts on some stocks at times, but the idea is not really to say buy, sell on anything. So I'll have to pass the stock part. But when it comes to Nifty, what we are thinking is, I don't know where the next stop is going to be, but one of the levels that I'm going to really be watching out for, if I just go to the chart that we were looking at earlier, give me a second. Yeah, is that we are going to see 19,000, close to 19,000 as a decisive point. If we are completing 1, 2, 3, 4, 5 here, if this is going to be 1, 2, 3, 4 and 5, then possibly this fifth wave completes, just below or near 19,000. If true, then we get some kind of an ABC correction. Now, the worst case scenario for such an ABC correction is don't go below the previous fourth wave's low. But right now, I don't know whether this will be the only case. Can this be still an extension? Can it go on into a larger upward structure without complete? Instead of 5 waves, can we extend to 9 waves? All those answers are not yet there. So we look at those possibilities when we get there. Also, I'm saying this is the worst case. We don't know. What if it's an ABC which is smaller and just ends over here? So that's again something I don't know. All I can say is when we complete 5 waves, we look for an ABC down. The current next level to anticipate such a pattern is going to be close to 19,000, and so we look at that over there. So that's my input on what to expect from the Nifty. So it looks like those were all the questions that we had, but I will just add one more final pointer based on this post. The White House reached a deal to avert a US debt default. Moment I posted this, there were a lot of replies and discussion on what is really happening with the bond market. How will equities react? Will they be bullish or bearish? Is this good news or bad news that the US is going to borrow more? Ritesh has mentioned that more borrowing, meaning treasury yields spike up and the dollar continues to rise. But then that's what it's already been doing. So what happens in markets is that people tend to front run these trades. Okay. And the anticipation that this debt ceiling raise can mean the US borrowing more has already led bond yields higher. Right. So bond yields have been going up over the last 10 days, in fact, and so has the dollar. So in my mind, the event could end up being more of a buy an expectation, sell on news event, which means the dollar was going up, now it peaks and reverses, or the bond market was going down and it bottoms out and turns up, which means bond yields were going up and they turned down. So does that really show up on charts? Because that's finally where we should find our answers. And I was actually looking at the US 10-year bond yield. I have written my answer on Twitter already, but I look at that chart as an addition. This is the 30-year, okay. So in the 30-year yield, you see a couple of things. One is you see some amount of volumes down here. Okay, so if you're looking at the bottom end, you can see this volume spike coming in at the bottom. Usually, if there's a selling climax or there's volume like this, which is buying into this rise. Okay, so one of those two things. So some volume building up during this phase each time the prices are dropping or rising from these lows. We're also seeing some kind of a triangular pattern try to develop inside the 30-year, and we've fallen below it. Now, while we're doing that, each time we've hit this bottom end of the range, the RSI indicators actually become oversold. So it got oversold here, it got oversold here. Here it's still not oversold, which is why I think on this debt ceiling announcement, bond yields may rise. Bond prices could fall a little more here. Okay. And while this looks like a triangle, it may not be. I've marked it as 1 2 1 2. It could be also. We'll see in terms of structure in the marking. But what I'm saying here is that a slight dip in the bond market, yields pop, and the RSI will drop below 30 and it will get oversold. And my sense is once that happens, you will start off a rally in the bond market. So I think this fall is already anticipated a spike up in bond yields and will eventually result in a reversal. Not only that, if you're not aware and you haven't really seen the data, you're looking at a chart of the CFTC positioning in the 10-year notes. Okay, so that is the speculative positions that people have taken on the US bond market, specifically the 10-year note. And this shows the highest ever short position. And it's been for a while like this, the short position was high. This week, highest. Surpassed all the previous readings. And this is what is happening. And this is also happening as the 10-year note had made a lower top and now is close to this top end of the range. The same pattern that I've drawn inverted, where you have a trend line of all the highs and I've drawn off the lows on the bond market. This is the bond yield and you have a huge short. So watching out for the possibility that a short position would be at play is that moment we move back and look at this chart, the moment it gets oversold, the shorts can start covering and you can actually end up with a decent rally. And in fact, my sense is it will be the bottom of the bond market was already in October last year. But these multiple bottoms, you can say whether it's a triple top or bottom or whatever you want to call it. But you will start a much more meaningful advance in the bond market, which has not happened yet, once this news is discounted. And so my sense is it's going to really result in a bond market rally after one knee-jerk reaction to the downside. Now, will that also be accompanied by a reversal in the dollar index? That's something I'm not right away betting on, but I do think that's an eventuality. So I don't know whether that will also happen simultaneously at this point of time, because we have surpassed 61% retracement. But one of the biggest components within the yen, apart from the euro, is getting pretty close to the top end of its range for wave C of a counter trend bounce, which means unlike what I've marked over here, where I've tried to say that this is 1 and 2, in case of the Japanese yen or the Chinese yuan, it's actually a big ABC going on. Okay, and 2 only ends here and then possibly 3 starts. And that is coming close to the 61% retracement mark. So, and in fact, the sentiment was almost 9% for yen bulls, which means very few people are bullish on the yen. So that's also a good reason why it may peak. But I'll leave it open. Let it do that last spike, like I said, in the yields in the dollar. This may just move up a bit more and then reverse. Whether we take it as ABC or whether we take it as, I've marked ABC over here. We can take it in both ways. And this can end up being 1, 2, 3, 4, 5, 6, 7, 8, 9. I don't know. We'll figure it out once we get the reversal, what the best count is. It can be one of the other, because see, this fall I've marked as 5 waves down for the dollar index, but it may not fit every currency pair in the same way, which is possibly why I'm keeping that open. Some of the pairs like the yen are ABC. So here's the euro, the opposite of this, and I've actually kept holding on to the idea it may be a 1 and a 2. So irrespective, the point is I think the bond market has a clear setup for a reversal. Will it result in a currency reversal also? That would be a double whammy. And will falling bond yields be good for equities? And that's where I think I have the 100% contrarian view to people expecting when yields drop, it means there's a recession and therefore equities fall. I think when yields drop like 1982, equities will actually rally, and you have the largest short position since 2007 also in equities, by the way. So that's another outlier that somewhere we ended with super short positions when we actually end up going to the CFTC futures and you can actually check them out on investing. Okay, so when you're looking at it for the S&P 500, this week the short position was even higher than the last 4-5 weeks, resulting in 404, which is 404,000 contracts short, highest since September 2007 when it was 408,000 contracts. Okay, so we are very close to making a new record, and this is happening like every week. Shorts are adding to the S&P futures because people are expecting it to fall, just like the bond market. So you have a bond and equity position which is completely short. And I don't know why news of the type that we are seeing right now. I mean, this was probably the last hurdle. You had the banking crisis, you had the debt ceiling. And if all of that is behind us, then why wouldn't it create a short squeeze in all of these markets? And I think that is what I'm thinking will end up being the case. Because even the banking crisis is over as far as the chart of the US bank index, so the infamous KBW index people have been following for years, trying to look for a global banking crisis. That index has fallen in A, B and C. Let me take a white chart. I've used a lot of black charts now in between. That has fallen in A, B, C very, very clearly over here. I think we published the chart last week on Twitter and other handles. I'll mention it here also. So this was a big A, we got a big B, and then we got a big C. Okay, and C is basically 5 waves, 1, 2, 3, 4, 5. Now we are 2 weeks positive from here. This fall is a 5-wave decline with a 5th truncated, and now that it's rallied for 2 weeks, everything is overlapped. There's no other way to count it. So if ABC is complete, that means the worst of the banking sector problem is over, and we should be going into a recovery phase, whether it's slow or fast. So banking sector crisis behind us, the US debt ceiling problem, behind us. You have a good reason for no more negatives till you can officially announce a recession. And if that takes time, then the market will take its own time to come down, and that's the reason for shorts to continue to squeeze. Now, will they squeeze or will the market keep rallying with more shorts adding at the top? I don't know. That is a bizarre thing that can always happen. It happened for once only in 2007. It has never happened before, and therefore, if it's an outlier, I cannot use that as a reason to think that every time that is going to be the case. And that is why my view for the time being will be contrary to the positioning till the setup on the charts tells me that the trend has really changed, which I don't think is really visible anymore. So I think that's all from me on this update. We've sort of answered all the questions on Twitter, and I've added my additional notes here on the market based on what has happened over the weekend. And this video you'll probably see it on Monday, I think, by the time it is published, though I'm recording on Sunday as promised, 28th of May 2023. Thank you.